Hey all, Chris Ulrich, United Home Loans, mortgage tips and everything else, and today we're diving into the mailbag. This email comes from Sean in Minneapolis, Minnesota. Sean says, "Hey Chris, I stumbled on your website when researching mortgage rates. I have a question I'm hoping you can help with. I purchased my condo at almost the exact same time as my friend last year. We used the same mortgage company and same loan officer, but I didn't realize until later that my friend's interest rate is 0.25% lower than mine. How is that possible? The only thing I can think of is when I told the lender that the condo association doesn't allow for pets, I made a nasty comment about cats being worthless animals. Looking back on it, I wonder if I upset her and it resulted in a higher rate. Hopefully that's not the case, but who knows, maybe I offended a cat lover. Any thoughts? Sean." Well, Sean, while I do agree with you on the worth of cats, I doubt that's the case. Your mortgage consultant doesn't make any more money by offering you a higher rate, and all of us loan officers value our business greatly, so there would be no reason to potentially jeopardize getting your deal by offering you a higher than market rate. Now, every home buyer is completely unique, and there are secondary market adjustments to rate pricing based on your specific scenario. The final pricing will ultimately determine your interest rate. We call these loan level price adjustments. So I'm guessing your adjustments were just slightly different from your friend who bought at the same time. Now, here are some examples of these loan adjustments. The most obvious is credit score. You'd assume somebody with an 800 credit score would qualify for a lower rate than somebody with, say, a 650. But did you know that the rate could be different between somebody with a 740 and a 739, or a 700 and 699? Just 1 point difference. There could also be an adjustment for your condo if your friend bought a single family home. Down payment, loan amount, occupancy type, and even the location of your home can result in a different loan level price or loan level price adjustments. Here's an example of how rates are impacted by these adjustments. Now, let's say the middle line is today's market rate for a vanilla scenario. Vanilla meaning that this person has excellent credit in buying an owner-occupied single family home with 20% down. Now, I'm just using 6% as an interest rate for demonstration purposes only, and we're going to call this a par rate because you don't pay additional fees nor do you get any credits for that rate. It's even Steven, right? Now, let's say there's an adjustment for being a condo and then another for a 680 credit score. As you start adding negative adjustments, the pricing goes below par and we need to make up for that loss in premium somehow. In this example, the negative adjustments equate to 175 basis points or 1.75 points. 1 point equals 1% of the loan amount, so this person could actually still get the 6% market rate, but we'd have to charge 1.75 discount points to get it. Or on a $100,000 loan, it would cost $1,750. Since most people don't want to pay thousands of dollars in additional fees, and often I'm asked to be quoted interest rates with 0 points, the most common option would be to raise the interest rate to one with higher pricing to cover or absorb the cost of those adjustments. So Sean, even though your lender might be a cat lover whom you greatly offended, it's more likely that you had different pricing adjustments than your buddy. If you're still confused or if anybody has questions, please don't hesitate to reach out. I'm happy to walk you through it all. Cheers.